The June Consumer Price Index inflation numbers came out this morning, and they were pretty bad. They revealed a 9.1% increase in prices from a year ago, which was an upside surprise from the numbers that experts were expecting. For those of you that might not be familiar with the Consumer Price Index, or CPI for short, it's a weighted average index looking at prices of the most frequent purchases by consumers in the economy. It is collected by the U.S. government through the Bureau of Labor Statistics, and the data is collected every month by measuring approximately 94,000 price samples all over the country by Bureau statisticians. All of these price measurements are logged and compiled into a monthly CPI report, which looks at price changes compared to the prior month and the year-over-year change in the category from the same month a year ago. CPI is looked at heavily by policymakers and economists as the primary gauge of inflation in the U.S. economy, so these measurements are taken very seriously and have effects on public policy. The headline inflation number from today's CPI report was a 9.1% year-over-year increase from last June, which is a very large inflation reading. For context, the CPI print for May was a year-over-year increase of 8.6%, so this 9.1% year-over-year increase is a significant bump in the headline number. In fact, the 9.1% year-over-year increase for June is the largest CPI print in 40 years. Many people are wondering because of this what this means next for the markets. In order to get an idea, let's look into the details of where the price increases were concentrated. As you can see on the CPI data table here in the actual CPI report, under the all items category, headline CPI inflation measurements increased by 1.3% from just a month ago, which is an acceleration in price increases from the prior month-over-month increases you can see earlier in the table. This increase was led by a 7.5% monthly increase in the energy category primarily, and a 1% monthly increase in food prices. But even in the core CPI numbers, there is a notable increase. Core CPI, so you know, is the increase in prices measured by the Bureau excluding food and energy prices. Core CPI is an important metric that policymakers look to in its own right because food and energy prices have heightened volatility generally. So core CPI excludes these to try and get a look at price increases by removing the most volatile components, which can be outliers in the data set. But even when excluding energy and food prices to look at the core CPI numbers this month, there was still a monthly increase of 0.7% from last month, which is an acceleration in the core CPI from the prior couple months. This really isn't a great reading, since even when taking out the largest contributor to price increases in energy, primarily, and then food, prices are still increasing in the aggregate in the other areas that CPI tracks. One of the most surprising and concerning increases in the core CPI measurements came in rent prices for housing. The report noted, quote, "The rent index rose 0.8% over the month, the largest monthly increase since April 1986, and the owner's equivalent rent index rose 0.7%, end quote. These measurements exceeded CPI estimates from observers by a notable amount, which is not a good sign for the narrative that inflation is peaking. While it's true that energy prices have fallen since June when these numbers were recorded, energy prices remain elevated, and there is risk that oil prices could go back up given Russia's status as a key global oil supplier and the war it is waging with Ukraine. If Russia cuts oil supply to Europe to discourage European assistance with Ukraine and to weaken their position to help, energy prices could rise again, and it's too early to say that oil has peaked for this reason, since the supply issues still exist. So even though energy prices have fallen for now, since these CPI numbers were recorded, it's far from clear that they will continue to fall, and they could remain quite elevated, which would not be good for future CPI reports. These inflation numbers mean that the Federal Reserve's hand will likely be forced into maintaining the course with high interest rate hikes. The market had been pricing in a 75 basis points or 0.75% increase in target interest rates by the Federal Reserve. But after this CPI report, it's now even pricing in the possibility of a larger rate increase of a 100 basis points hike or 1% increase in the federal funds rate. With a very high inflation report, the Fed is going to be forced to continue to aggressively raise interest rates in order to try to slow down consumer demand and slow price increases in the economy to fight inflation. Regardless of whether the Fed announces a 75 basis points or a 100 basis points interest rate hike, the interest rate hike will put more pressure on the stock market and assets, as it has a twofold effect. Higher interest rates will continue to compress valuations for stocks like they have been, as investors are willing to pay less premium in the form of sales multiples for companies. Since bonds and other debt lending are a lower risk way of making a return, and the rate of return for bonds is increasing along with interest rates, investors can start to allocate more money into bonds instead of the stock market, which generally starts to compress the multiple of the stock market or how much people are willing to pay for a premium in stocks. Secondly, interest rate hikes will likely start to slow consumer demand, which will hurt revenue and earnings for many company stocks. Decreased earnings will then put pressure on the company's stock prices, as the stock's price will need to decrease in order to match the decrease in earnings in order for it to maintain the same price to earnings ratio it had before. Because of the CPI report and the high inflation numbers we are seeing, the Federal Reserve is backed into a corner here and is going to be forced to continue with major interest rate hikes to restore price stability and slow inflation. This will have the effect of slowing down the economy while they are raising interest rates, and will continue to put downward pressure on stocks in all likelihood. What do you think about this CPI report, and were you expecting the numbers to come in this high? Let me know in the comments below what you think, and be sure to subscribe to the channel for more finance content. Thanks.